Okay, dear performance management students, I'm Abeel, I'm a PM expert. Let us discuss one question again. As usual, we are taking the coming question also from the study hub, and this question is on pricing, but it's a not a usual question. I would say it's sort of unusual question, but let's attempt. Then it will give you a lots of, I would say, knowledge. Then how to deal with even an unusual questions, because all the time we should not be expecting a usual, I would say, question. Okay, so let's try this question is very interesting. Okay, what selling price will maintain the markup 25% on full cost? First of all, student, you should know the difference between markup and margin. Markup is a percentage of cost. The equation is cost plus profit is equal to selling price. In case of markup, the cost is 100%. Here comes your markup, and obviously the selling price is 125%. So markup is a percentage of cost. Now what exactly examiner is asking? They're asking what selling price will maintain. What should be the selling price so that markup remains 25%? Okay, let's read the scenario. Rohi sold 2,000 units of a product during there at a markup of 25% on full cost. Okay. The selling price was 100. Fixed cost is 40,000 units. Fine. Next year variable cost. Next year variable cost of production are expected to increase by 10%. So next year what is going to be, what is going to happen? Your variable cost will increase by 10%. Fixed costs of production and the sales quantity are expected to remain unchanged. Now this is important. Fixed costs next year remain same, and plus they are saying the sales quantity, which is 2,000 units right now, it will remain same in the next year as well. And they are actually asking what should be the selling price simply the next year, because the next year variable cost will increase by 10%. So obviously due to fixed cost plus pricing, the next year price is not going to be $100, number one, and logically it has to be more than 100. Why it has to be more than 100? Fixed cost remains same. Okay, the quantity of units sold will remain same. Only there is a change in the variable cost, and there will be a rise in the variable cost. So it is quite obvious, students, when the variable cost will rise, then obviously your total cost per unit will rise. When the total cost per unit will rise as compared to the previous year, so obviously the selling price is going to be higher than the previous year. But we need to calculate that. So let's try. First of all, fixed cost remains same. The units which we have sold in this year, they will remain same in the next year as well. Now the benefit is, if I take 2,000 units, we can very easily calculate the fixed cost per unit. 40,000 divided by 2,000. That will give us fixed cost per unit 20. So the next year also the fixed cost per unit will remain 20. So at least for the next year we know the fixed cost, which is 20. It is in the current year it is 20. In the next year it will remain 20. Okay, what else? Selling price examiner has given us, which is 100. Okay, this is existing selling price. From the existing selling price we can calculate right now the existing total cost per unit. What is the benefit if we can calculate from existing selling price, from the current selling price, the current total cost? I will tell you the benefit. Let us first calculate. Markup is 25%. It means this selling price, which is $100, it is actually representing 125%. So very easily we can calculate cost, which is 100%. Take the selling price $100. In markup, the cost is 100%, and due to 25%, I would say markup, the selling price is actually representing 125%. So I'm multiplying this selling price with 100 divided by 125. This will give us the total cost per unit. So let's calculate the total cost per unit. Students, the total cost per unit is 80. Now listen to me carefully. If the total cost per unit is 80 and fixed cost per unit is 20, so we know that total cost minus the fixed cost will give us variable cost of the current year. So simply total cost per unit we have calculated, which is little bit messy. Let me, it became more messy. Wait. Total cost per unit is 80. If I deduct fixed cost, which is 20 per unit, so logically per unit students, the variable cost per unit is 60. Variable cost per unit is 60. And question says that variable cost in the next year will increase by 10%. So no issue at all. Variable cost for the next year is going to be 60 into 1.1. Variable cost for the next year is going to be 66. Fixed cost remains same, which is 20 per unit. So student, next year, your total cost of this company will be 86. If the total cost per unit is 86 and the selling price is 25% markup, so this 86 should increase by 25%. That will give you the selling price. Because markup is a percentage of cost. So this, either you take right 86, then calculate 25% of 86, add that into 86, you will get the selling price, or simply take this 86, multiply by 125 upon 100. Logically, 86 is representing 100% and we have to bring it at 125%. So students, logically, the next year's selling price should be $105. At a selling price of $107.5, just a slip of tongue, I would say, apologies, slip of tongue, it is actually 107.5. So 86 multiplied by 125 upon 100 gives us $107.5 selling price, which means at a selling price of 107.5, you can maintain the markup of 25%. So let's see, the answer is B. That is again a question from the study of, let's see what they have done. So they have also calculated the same thing. Of course, the steps are not same, they are different. But at the end of the day, you can see that we are getting the same result. We and study hub, we can see eye to eye. Here, as far as answer is concerned, we and study hub, we are on the same page. So thank you very much for watching this concept building video. And don't forget, if you're planning June attempt, you should contact Abeel School of Accountancy for a free crash course of PM. The entire course is going to be live online. Thank you very much.